You will learn more in this free course than any paid course out there. I have been trading for 4 years now, and I have compressed everything I know about price action trading into this 1 hour video. So here's what you are going to learn: why trade price action, market structure, trend direction, support and resistance levels, trend lines, Japanese candlesticks, and chart patterns. Now, these are the foundation of price action trading that I believe that every single trader out there need to master. I have nothing to sell you here. I'm not here to sell you a trading course or sickness. There's a lot of trading gurus out there trying to scam you, but I've always been honest and transparent since the day I started this YouTube channel. There's a ton of free trading courses on my channel, and in this video, I'm going to try my absolute hardest to change your trading for the better and add as much value as possible for completely free. Everything that I'm about to share with you here will change your trading, and I don't want you to miss a single crucial step. So all I'm asking for you is to focus. Put your phone away, stop reading the comments below this video, put this video on full screen and give me your complete attention. Because if you don't even have the patience and the focus to watch this 1 hour video, how are you going to become profitable at trading? And I will actually recommend you to grab a pen and paper to take down some notes. The first question you might have is, why trade price action? The truth is, all indicators lack and they are absolutely useless. They are trash. They do nothing but distract you. Since all indicators are just reflecting what price is doing, price is the only thing that you really need. Now, the markets are moved by the market participants, and the price chart is a reflection of this. It is the combination of thoughts, behaviors, patterns, and actions of all these participants. You can literally see a story unfold behind the price chart. Price is telling you who's winning and which side you should be on. The only question is, are you listening? Now here's the fun part. Let's go to the charts and I will explain to you exactly how you should trade price action, and these are what we are going to cover. So when it comes to market structure, right, what is market structure? Market structure is essentially the way the market moves. So what I mean by that is that in market structure, you must understand that the market, it will never go up in a straight line like this, or it will never go down in a straight line like this. In an uptrend, price will be going up, retrace a little bit, going up, retrace a little bit, and then go up, retrace a little bit, and go up even further. How this works is that there will be a lot of buyers pushing the price up, and then essentially it will lose steam. The buying pressure will lose steam, and some sellers start to come in and push the price down and causing this retracement. And then more buyers will come in to push the price up again, and then price will start retracing again and then go up and down again. So essentially, in this case, this is what we call an uptrend, and price is creating your higher highs and higher lows. So this is a higher high, this higher high, this high is higher than this high, and this low is higher than this previous low. So this is what we call higher highs and higher lows in an uptrend. So let me just put that down. So in the uptrend, price will be creating your higher highs and higher lows. Remember these guys, very important. Market structure is very important. And you might think that right now it looks very simple, but trust me, it's not this easy on the charts, because you will start to see that market structure actually looks something like this. Yeah, it will look very confusing on the actual chart, but when you come down to understanding market structure, if you can understand that uptrend, price create higher highs and higher lows, you will be able to understand more about how to identify the correct trend direction. So on the opposite of uptrend, we have a downtrend. So in the downtrend, price will be creating your lower highs and lower lows, right? You can see price will go down, retrace a little bit, go down, retrace a little bit, go down, and retrace a little bit. And then you can see, in this case, price is creating your lower highs. You can see this high is lower than this high, and this low is lower than this low right here. So downtrend, price will be creating your lower highs and lower lows. Lower highs and lower lows. And then the third market structure is consolidation, right? This is consolidation when price is going sideways. In that case, we don't really want to trade, right? We want to stay out of the market. I've learned this the hard way, because like when price is consolidating like this, right? there is no 100% certainty that price is going to bounce from this level all the way up to this level again. Price can go like somewhere right around here and then starts reversing, and then go up, starts reversing again. So it's a very tricky part to trade. And in my first year, I lost a lot of money trading consolidation markets. So if you're a beginner, I would just advise you to stay out of the market when price is consolidating. Example right here. You see right here, price is just consolidating, not going anywhere. Stay out of the market. As simple as that. So next is consolidation. Okay, let's look at some example. Let's say this is market structure and also plus trend direction. We are learning 2-in-1. So this is the basis of market structure and trend direction. You can see in the uptrend, price is creating higher highs and higher lows. Downtrend, price is creating a lower highs and lower lows. So in this case right here, right, on GBUSD, look at what price is doing right here. Would you say this is an uptrend, downtrend, or consolidation? It is obviously an uptrend because price is creating your higher highs and higher lows. See, higher highs and higher lows. This low is higher than this low. This high is higher than this high right here. So uptrend, price creating higher highs and higher lows. So before this uptrend, look at what is happening right here. Consolidation. Price is going sideways, up, down, up, down, up, down, up, down. In this case, this is what we call the consolidation phase. And then before that, before the consolidation, look at what happens. Lower high and lower low. Lower high and lower low. So in this case, it's a downtrend. So price move from downtrend to consolidation to uptrend. This is essentially what I mean by market structure. The thing about the market is that you must understand that price will not just go anywhere randomly, like just go zigzag, zigzag anywhere. No, price has to follow a structure. There is an order to the universe. There is an order to the markets as well, right? Price will follow structure. So how it works is that price will always either be going up, down, or sideways. There's only these three trends, right? There's only these three trends, either up, down, or sideways. So how do you know when price is going to reverse, right? Like what happened over here. Price reverse from a downtrend to an uptrend. How do you know that it's going to happen? And how do you predict that it's going to happen? Next concept is what I call the break of structure. So essentially, what is a break of structure? Let's take a look at break of structure. So essentially, like I said, right, let's say price is creating an uptrend like this. Higher highs, higher lows. Very beautiful high highs and higher lows. At some point of time, price will start losing steam. You can see price starts losing steam and it starts consolidating, right? Because right now, there's not much buyers inside the market right here, and then the sellers are going to challenge the buyers because there's not much buyers anymore. The buying pressure and momentum has faded away. So that is why price is consolidating right here. There's like an equal amount of buyers and sellers in the market right here. At some point of time, the buyers are going to be outnumbered by the sellers. So a lot of people see this and they're going to start selling, creating a lot of selling pressure and momentum, and then price will drop. When price drop, this does not mean that price is going to reverse to a downtrend yet, because price can easily drop like this and still went back up. Why? Because this low is still higher than the previous higher low. Market structure is still present. That is why, to identify a clear break of structure, what you want to do is to wait for price to break through the last previous higher low. You can see this is the last higher low, right? Break through it, come back up to retest it to create a new lower high. This high is lower than this high right here. In that case, we can confirm that price has reversed from an uptrend to a downtrend, and price is going to start creating lower highs and lower lows. And that is the beauty of break of structure. And that is how you can identify a reversal before it actually happens, is to wait for price to break structure. Let me repeat once again, guys. Just because price go down like this and you start seeing a little bit of selling pressure does not mean that price is going to reverse and hit back down already. You still must be patient. Be patient enough to wait for the break of structure. And the break of structure only comes when you wait for price to break through the last higher low, come up here to create a new lower high, then that is counted as a valid break of structure. So let's apply what we have learned. Over here in this example, right, what did price give us? Price gave us lower highs, lower lows at the start, clear downtrend. But then somewhere right around here, price starts consolidating and losing steam. Like I said, at some point of time, the sellers will go away, right? This selling pressure cannot be forever. Whatever goes down must go up. Whatever goes up will eventually comes down. That's the nature of the market. That is market structure at its finest. So over here, price started losing momentum, losing steam, and it starts consolidating right here. Starts consolidating right here. And you can see where is the last lower high? The last lower high. The last lower high will be this one right here. You can see, after price created this lower high, there was no more lower highs. There was no more lower highs over here, right? Price did not create any more lower highs, right? Price just started to consolidate around this area here. So this is the last lower high. So what we are essentially looking for is for price to break through this last lower high right here. Because if price is able to break through this last lower high here, it will give us a confluence and tell us that price has broken structure. Market structure has been broken and price is going to reverse from a downtrend to an uptrend, right? So wait for price to break through this area right here, or you can even call this as the last lower high. Actually, you can see this area right here. Yeah, this high is also lower than this high right here. So either this one or this one is fine. Yeah, so let's assume that you want to put at this one, right? This is the last lower high. So in this case, price actually went up, break past the last lower high right here. You can see, right? Let me just bar replay this shit again. Price broke through the last lower high. But does this mean that price is going to reverse? Yes. No, because you have to wait for price to come down and retest this last lower high to create your new higher low. Then that is when we can enter for the trade. So at this point of time, we still wait for price coming down to retest. You can see price starts coming down to retest this last lower high. We are waiting for price to create a higher low. Boom. You can see this low is higher than this low right here. So price has broken market structure because price has broken the last lower high right here, and then it has come back down and create a new higher low. And then price is eventually gonna go up and create another higher highs and higher lows and reverse to an uptrend. So for support and resistance levels, right, what we are looking for is essentially levels where price is reversing at. So support level basically act as a floor. Resistance level act as a ceiling. Pretend that you have a ball in your hands right here now. And then you throw the ball upwards. And then there's a ceiling right here. The price is the ball is going to go up to this ceiling and then bounce off this ceiling. That is your resistance level. It's basically a level where price is gonna bounce off from the upside. Now, let's say same scenario, but different circumstance right now. Let's say you have the ball in your hands again, but you drop the ball instead. You drop the ball instead. And then we have a floor right here. So price is gonna go down to the floor and then bounce off the floor. This is your support level. So support level essentially act as a floor for price, and a resistance level essentially act as a ceiling for price. So support and resistance, right, are basically levels where price has stopped at multiple times. So let's say this level right here, price starts going up here and then reverse, and then starts going up again, reverse again. Now, price tried to break past this level one time, two times, and it failed to break through two times. It is counted as a resistance level, right? So it must have at least two touches. So the next time price come out to this resistance level again, you can expect price to reverse at this area. You can expect sellers to be waiting at this resistance level to short the price down. So that is what I mean by resistance level, right? But bear in mind that this is not foolproof. Sometimes price will break through the resistance level if there is enough pressure, right? This will be what we call a breakout. Yeah, but this is ceiling, a resistance level. So support level is basically the opposite. Is where price come down here
fail to break past, go back up, come down again, test it again, fail to break past again, go back up. So 2 touches, price fail to break past 2 times, it is counted at the support level, and the next time price come down here, you can look to enter for a buy somewhere right around here. So back to live scenario. So the reason why I mark up this level is because look at what price did. Price comes down, go back up at this level. Comes down again, go back up at this level again. So 2 touches, one here, one here. 2 times price failed to break past this level. You didn't know this is a goddamn support level, and you can look to enter for a buy at this level right here. So price come back down to this level here and then reverse here. You can see you can enter for a buy easily right here. This is for support, and then for resistance, resistance could something be like right here. At this level, price went up once, reverse. At this level, go up again, and then starts reversing again. So you can see in this area, right, price encountered a resistance at this level here because it failed to break past this level 2 times, right? So the next time price comes up to this level right here, you can expect it to have some sort of selling resistance. You can see right here. Price came up to this level once again and it started having some selling pressure right here. You can see some selling pressure right here. But eventually, because this uptrend is so strong, right, there's a lot of bullish momentum and pressure, it essentially broke out of the resistance level, come back down to retest this resistance level, and now it acts as your support level. So that's another principle I want you guys to learn, right? When price break through a key level like this, right? When price break through a resistance level, let me put it down. When price break through resistance level, that resistance level becomes support level, and vice versa. So if price break through support level, that support level becomes resistance level. So in this case, right, what happened was that price break through the resistance level and then come back down and they act as the support level now. You can see 1 time, 2 times support level right now. So that is support and resistance. Basically, it's very, very simple. You just need to find an area where price has like failed to break past multiple times. I can easily spot so many right here, one here, and then there's another one like somewhere right around here, a resistance level here, 1 time, 2 time, 3 touches right here, and then there is also a support area right here, 1 time, 2 time, 3 touches, and then there's a resistance area right here, and then there is another resistance area right here, 1 time, 2 time, 3 time, and then yeah, there's a lot of resistance area right here because it's a downtrend, and in an uptrend like this, there's also support level like somewhere right around here. You can see I'm easily able to spot support and resistance levels because it comes with a lot of like experience, right? You're able to just spot it within 5 seconds, right? Comes with a lot of experience, right? So yeah, just practice more and you can get the hang of it easily. Remember, as traders, we want to trade with the trend. Why? Why do we want to trade with the trend? Because think about it in this way. You are a small fishing boat in the sea. Right? You're a small fishing boat in the sea. The waves are strong, right? The waves are very strong. Forgive my terrible drawing, but let's say this is you. You are in a small fishing boat in the sea. The waves are strong. The current is strong. And the current is going this way. Would you go against the current by trying to go this way, or go with the current and try to go this way? Any idiot will tell you that you will try to go against the current, because if you try to go against the current, it's like going against the nature of the universe, right? It's essentially eventually the waves will come up and drown you and you will die, right? That is why as traders, it's the same concept. We want to trade with the trend. The trend is the power, right? The trend is where essentially is the power is at, the liquidity, the pressure, the momentum is at. Example, trading the trend will be in the uptrend, you want to look to enter for buy, right? You want to look to enter for a buy because it's an uptrend and price is creating high highs and high lows, high highs and high lows, and there's a lot of opportunities where you can enter for a buy. And then in a downtrend like this, you want to enter for a sell, right? You have to enter for a sell. right? There's a lot of opportunities where you can enter for a sell here. Now, you're wondering, can I trade against the trend then? You can. Example, if you're a scalper, let's say you're just a scalper and the overall trend is uptrend, but this is a trend in what? The higher time frames, the daily time frame. So there's no point in you looking at the daily time frame. In that case, you'll probably be like at a 5-minute time frame. In a 5-minute time frame, you can see there's a lot of noise right here. Price going up, down, up, down, up, down, up, down constantly. In this case, if you enter for a sell right here, you are going against the overall trend on the daily time frame, because the daily time frame, the overall trend direction is an uptrend. The long-term trend direction is an uptrend. But you are scalper. You won't give a shit about the overall trend direction, right? Because you're just getting in and out of the trade within 5 minutes, 15 minutes. So the overall trend direction does not really matter to you. But with that said, bear in mind, if you trade against the direction, you will never ever know when the overall trend is going to eat you up alive. What I mean by that is that, let's say you're stuck in a 5-minute time frame. You're going about your scalping routine, right? You're getting in and out of the trade. And then you enter for a sell somewhere right around here. You know, maybe let's say enter for a sell somewhere right around here. Okay, you enter for a sell, having your target right here. So you want to exit right here. And then you're happy, you know, like, oh, price went in a profit, you're happy, you're celebrating, you're popping on champagne, you're like looking at what you're gonna buy if you're trading profits. And then next thing you know, this shit happens. Because the big money, the smart money, the big financial institutions have entered the market because they are looking to load up their buy positions to trade with the overall trend, which is the uptrend. That is why I asked you guys to trade with the trend direction. At this stage, you're still a complete beginner, especially if you're a beginner, trade with the trend direction. If it's an uptrend, look to enter for a buy. If it's a downtrend, look to enter for a sell. As simple as that. There is no need to complicate things. I made a lot of money with this simple rule by following the trend direction. I lost a lot of money by trying to go against the trend direction. The reason why I'm telling you this story is because I experienced this myself. Back when I was like a scalper in my first 2 years of trading, I was just constantly getting in and out of the trade, and I will look to trade against the trend, and I will always end up getting burned and just losing a lot of money. So please do not make this mistake, right? If you want to trade against the trend, trade it at your own risk, right? Trade it with caution. So what are trend lines? So essentially, right, trend lines is basically lines that is able to help us identify the trend. And if we can identify the trend, we can trade with the trend. So how do you draw a trend line? In the uptrend, where price is creating higher highs and higher lows like this, right? How you draw a trend line is by connecting all the higher lows. These higher lows right here. So you take the trend line tool that can be found somewhere right around here, trend line. Connect this higher low to the other higher low and just boom, then you have your trend line, right? Basically by connecting the higher lows together. So how it works is that essentially the next time price come down to this trend line right here, you are expecting price to bounce off this trend line. And that is when you can enter for a buy right here, right? Expecting price to bounce off the trend line, come back down here, price bounce off the trend line again. And you can enter for buy here. So this areas where prices come back down to this trend line is essentially areas where you can look to enter for a buy. So this is the trend line in the uptrend, and you basically draw an uptrend trend line by connecting all the higher lows of price. Next, what about downtrend? In the downtrend, when price is creating lower highs and lower lows, lower highs and lower lows like this, lower high, lower low, lower high, low, low. In this case, how you draw a trend line is by connecting all the lower highs. This is the low high, this is another low high. So take a trend line to connect the lower highs like this. Lower highs, guys, not lower lows, okay? Not lower lows. Lower highs. I remember in my first year, I always got this confused and I always end up drawing the trend line here and I'm wondering how do you sell if it's like this. So always make sure you draw at the lower highs. So once again, next time price come up to this downtrend line, you can look to enter for a short position, enter for a sell here, and then again, bounce off again, enter for a sell. So that's a trend line bounce strategy, right? Basically, where price is bouncing off the trend line, you can look to trade in that direction. But then, what if price break through the trend line? Say, let's say price come up to this trend line right here, right? Instead of bouncing off like this, it broke through it. What do you do in this case? When price break out the trend line, it means that this trend direction is about to change. So that's the second way they can identify a reversal, when price has broke out of the trend line. So in this case, price has broken out of the trend line. There's a chance that price is going to reverse and it's going to create higher highs and higher lows and reverse to become an uptrend right now. But at the same time, you have to be careful, because sometimes what price can do is that, so you'll just tip their head above the trend line and then go back in like this. In that case, that is what constitutes as a fake out, right? Once again, a real breakout is if price break through the trend line, just continue going up, high highs, high lows. So you can tell by looking at the candlesticks that is performing at the trend line. Is there a lot of candlesticks pressure, a lot of candlesticks momentum at this level? If there is, most likely price is going to reverse and price is going to hit up. So let's look at how we can apply this in real time. So in this case, you can see price is creating your lower highs and lower lows. Now, okay, the thing about trend lines is I want you guys to bear in mind that on some currency pairs, right, it's going to be very hard to draw a trend line. And when you can't draw a trend line, don't force it, okay? Don't force it yourself to draw a trend line if you can't draw a trend line. In that case, fall back to market structure. Look at the trend direction based on market structure. Is price creating lower lows, the lower highs? Then that is downtrend. Price is creating high highs, high lows, then that is uptrend. So if you can't identify the trend direction, fall back on market structure. So over here, let's say price is in the downtrend. Price is in the downtrend right here, and price is creating your lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. In that case, we can draw a beautiful, beautiful downtrend right here, connecting all the lower highs right here. Okay, once again, right, it's the same thing as support resistance levels. In order for this trend line to be valid, it needs two touches. One right here, another one right here. Two touches, it is valid. So the next time price come back up to this trend line, we can look to enter for a sell. So you can see price go down, really create low high, low low, go down. But this time it didn't really touch this trend line, so you can still wait. And then boom, over here, price comes back up to touch this trend line right here. This is when you can look to enter for a sell right here. And then goes down, creating a lower low again. And boom, come back up to the trend line again. You can look for your trend line bounce right here, enter for a sell right here. And then same thing right here, trend line bounce over here. So in this case, this is how you can short the market down, right? This is how you can look for places to enter for a sell. Now, what if it is in an uptrend? In an uptrend, price is creating your higher highs, higher lows, higher highs, and higher lows. So in that case, we want to draw a trend line connecting all the higher lows. So connecting all the higher lows like this, you can see one touch, two touch, it is a valid trend line. So the next time price come back down to this uptrend line, we can look to enter for a buy. So you can see price goes up and then come down, retest to this uptrend line, we can look to enter for a buy right here. You can see so on and so forth. Yeah, this is what I mean by fake out, guys. You can see, look at what price did. Price break through the trend line and then just go back in like this and just continue this uptrend, right? In order for this trend line to be valid, right, price has to break out this trend line, create a lot of momentum and a lot of selling pressure for price to just reverse and head down, or even wait for price to break out the trend line, come back up to retest the trend line, and then go down like this, right? Bear in mind that these breakouts, right, they don't always retest. That means price won't just break out and then just retest immediately. Sometimes price can just go straight down without any retest. So you have to play by ear when it comes to trend lines and stuff, and really observe what the candlesticks are showing you at the trend line. So that is my tip for you. And in order to do that, you have to understand candlesticks.
So there is two types of candlesticks. A bullish candlestick, which is the green one right here, and then a bearish candlestick, which is the red one right here. In a bullish candlestick, price is going to open below and close at a price that is higher than its opening price. Obviously, right? Because when price open right here, price is going to get pushed up. The buying pressure is going to push price up. Eventually, it's going to close somewhere down here. But at some point of time, when price is forming this candlestick, price can get pushed all the way up here before it starts to come down and close right here. And then in that case, this was the highest point price went to at some point of time. And that is what we call the high. And then this is the lowest point that price went to when price is forming this candlestick. So when price forming this candlestick, price literally went all the way down here before it went back up here to close at this level right here. So this is what we call the low. So this is the low, this is the high, and this is the open price, and then this is the closing price. So you can see in a bullish candlestick, the price closed higher than the opening price. In a bearish candlestick, it's the opposite. The bearish candlestick price open right here, and then the sellers start to push all the price down, right? Push all the price down, 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 down. Eventually, it went all the way down here. So that's the low, and then eventually ended up closing right here, leaving a trail behind. So this is the low, this is the high, and this is the closing price. You can see the closing price is lower than the opening price in a bearish candlestick, while in a bullish candlestick, the closing price is higher than the opening price. So this is what we call the candlestick wick. You can see this line over here, these two line right here. This is called a candlestick wick. This is the upper wick, this is the lower wick, upper shadow or lower shadow, whatever you like to call it, upper wick or lower wick is the same shit. So this is the wick, and then this is the candlestick body, right? This is the candlestick body. So that is the anatomy of a candlestick. Yeah, but basically you can see this is essentially how a candlestick work, right? There is a lot of candlestick patterns that you can memorize out there. Like if you memorize this pattern, that means price is gonna go up. If you memorize this pattern, that means price is gonna go down. For me, I always tell my students there is no need to memorize all the candlestick patterns out there. You hear this advice all the time. All you need to do is to go memorize this candlestick pattern or that candlestick pattern, and then look out for this candlestick pattern when it comes out. There is no need to do all that. If you can understand candlestick pressure, candlestick momentum, how do you understand candlesticks without memorizing all these complicated candlestick patterns? Look at the candlestick's body and the candlestick wick. Let me explain to you guys. So let's say you have two candlesticks. Candlestick A, this right here is candlestick A. This right here is candlestick B. You can see both candlestick, it is about the same length. But in this case, what is the difference here? The difference is the size of the body compared to the size of the wick. You can see in candlestick A, there is a big candlestick body, and then in candlestick B, there is a small candlestick body. This tells us everything we need to know about price. The thing about indicators, all the trading indicators, RSI, Bollinger Bands, moving averages, all these things lack, right? All these indicators, they lack. That is why we purely focus on price action. And the fundamental of price action is to focus on price. And what is price? Price presents itself when you look at the candlesticks, when you look at who is in control of price. And we can tell by looking at the candlesticks, we can tell whether the buyers or the sellers are in control of price. So in this case, in candlestick A, there's a bigger body. This tells us there's a lot of buying pressure and a lot of buying momentum. Compared to candlestick B, with a small little candlestick body and there's a very long wick. This tells us that there is lesser momentum and lesser pressure. So there is maybe probably about like a 20% buyers. While over here there's 80% buyers and 20% sellers. Well, over here, there's like 80% sellers. Maybe not 80% yet. Maybe this is like a 60% buyers, 40% sellers, right? And we literally got to tell who's in control of price just by looking at the candlestick. That is how powerful the candlestick is, right? By looking at a candlestick momentum and a candlestick pressure. That's my first tip for you guys, is to look at the candlestick body, right? To compare the candlestick body. Oh, look at the candlestick body, right? If the candlestick body is big body, equal momentum, equal large momentum. Small body, equal lesser momentum, and buyers inside the market. So small body basically means lesser buyers inside the market. So that's the first tip. Look at the candlestick body, right? Because like I said, price tells us everything. Next, second tip would be to compare the size of the candlestick body to the size of the wick, the candlestick wick. So another tip is to compare the size of the body to the size of the wick. In this case, right, you can see this candlestick is about 80% body and only 20% wick. And this is 20% body and 80% wick. So same thing right here, right? When we compare the size of the body to the wick, you can see that there is more wick equal less momentum or pressure, right? That means less buyers, and that translates to less buyers, right? And then the third tip would be candlesticks can get confusing. That is why I recommend you to actually focus on candlesticks at a key level. So if you look at a candlesticks like this, right, it can get very confusing because price can go up, down, up, down, up, down. And if you look at these green candlesticks, you will think that, oh shit, price is supposed to be going up. And then next thing you know, price has go down. And then you look at a red candlestick, you think that, oh shit, that the price is gonna go down and just gonna continue going down. And next thing you know, price are reversing, go up, down, go down, blah, 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 and it gets super duper confusing. In this case, you need to fall back to the principle that you should only be focusing on the candlesticks that is at a key level. That means you should not be giving a shit about candlesticks that is in the middle of nowhere. You should only be giving a shit about candlesticks that is at a key level. Right? At a key level. So back to support and resistance levels. So let's say we have identified a support level right here and we have identified a resistance level right here. Okay? We have identified these two levels. When I say focus on the candlesticks at a key level, what I mean is that these candlesticks right here and these candlesticks right here. That means all of these candlesticks in the middle of nowhere right here, all these are noise. All these are just there to confuse you even further. All you need to know is to see the candlesticks at the key level to tell whether price is breaking through this key level or is it going to reverse at this key level. And you can find out the answer by looking at who is in control of the price once again and by analyzing the candlesticks. Example right here. What we saw in this scenario over here was that there was a lot of selling pressure right here, right? You can see large bearish candlesticks, big bearish candlesticks, a lot of selling momentum and pressure pushing the price down, 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 down. And then as price approaches this key support level, we know that this is a key support level. Maybe if you look at like the history, price has came down to this level before. Yeah, so this is a very key support level. Let's just assume that it is. And then there's going to be buyers waiting at this support level to push the price up. In that case, what you want to do is to observe the candlesticks as it approaches the key support level. You can start to see it starts to lose momentum, it starts to lose pressure, right? It starts to make smaller candlesticks. You can see candlestick gets smaller and smaller, and then over here it just comes down all the way down here and it stops abruptly. And it stops abruptly, and look at what happens. Look at the candlesticks at the key level. It tells us everything we need to know. What's happening here? Candlestick wick, candlestick wick, candlestick wicks, a lot of lower wick right here. What does this lower wicks mean? It means that at some point of time, price was trying to push, the sellers was trying to push the price all the way down here, all the way down here. That's why it's creating this low, 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 low right here. But it always end up, the buyers come in and save the day and push the price all the way up. And you can see all the candlesticks right here, they always close above the key level. Look at this area right here. They always close above the key level. Oh my God. What does this mean? This means that price is not going to break past the support level and price is potentially going to reverse and hit back up. In that case, easily you could have entered for a buy somewhere right around here. Easily. So once again, let's look at another example. Price starts creating high highs, high lows, and we saw that price is approaching this resistance level. And at the start, there's a lot of buying momentum and buying pressure. How do we know that? Look at the candlestick body. Big bullish candlestick, a lot of buying pressure and momentum, pushing the price up. And then retrace, and then a lot of buying momentum and pressure continue pushing the price up. And then look at what price happens over here. The candlestick starts to get smaller. Just compare these candlesticks to these candlesticks right here. So another tip is to compare the size of the current candlestick to the previous candlestick. And it will tell you everything. Once again, right here, you can see right here. Example right here, right? You can see this big red candlestick engulfing this small little blue poor little candlestick. And look at what happens. A retracement. Sellers enter, push the price down. Once again, over here, You can see the blue candlesticks start to get smaller and smaller, right? The momentum fading away, the buying pressure going away, right? And then look at what price give us. A huge red candlestick at a key resistance level. Clear as day. Price is about to collapse, right? Price is about to collapse. Sellers have entered the market and there's a lot of selling volume coming inside the market. But then price starts to go up again to test this level again, right? To see okay whether it's like actually solid, whether this is actually a solid resistance level. And it got rejected, hit back down. Never mind, they test again, rejected third time. Another same scenario. Look at this big red candlestick engulfing this small little candlestick. This is what we call a bearish engulfing candlestick pattern, by the way. And you can see, look at what happened. Price collapse. Price collapse, create lower highs, lower lows, starts consolidating around this area before it finally broke past this area right here with huge bullish momentum, huge pressure. You can see just by looking at the candlesticks, I'm able to tell what price is going to do. I'm able to tell who is actually in control of the market right now. Is it the buyers or is it the sellers? And that's all trading is about. Understanding who is in control. Is it a boost? Is it the best? And then if you understand that the bulls are in control, then you should be looking to buy. If you're understanding that the bears are in control, then you should be looking to sell. Because like I said, you gotta trade with the trend. So those are my tips for candlesticks. If you can genuinely get these tips nailed down in your head, right? Understand candlestick momentum, candlestick pressure, and liquidity, all these things. You don't need the freaking candlestick pattern cheat sheet because you understand why the candlesticks form, how they move, and where they are going next. Focus on 3 candlestick patterns. I almost forgot to mention this point, but find 3 favorite candlestick patterns that you love, that it works, and then just focus on finding those 3 candlestick patterns. Let's say for me in this scenario was that the first candlestick pattern that I really like is the bearish engulfing candlestick pattern. And it's this pattern right here where there's a big red candlestick engulfing the small little green candlestick. And when you see that, that means you should enter for a sell. And I saw it right here, right here, and right here. And that presented me selling opportunities. So that's the first candlestick pattern that I like to focus on, the bullish and the bearish engulfing candlestick pattern. And then there's another one that is the 3-line strike. So if I see this, I'll enter for a sell. And if I see this, I will enter for a buy. This shit is wrong, by the way. Like I said, this is supposed to be selling pressure, because if you look at this huge red candlestick right here, once again, fall back to the premise of understanding candlestick pressure and momentum. You will know that when you see this big red candlestick engulfing the previous 3 candlesticks, god damn it, price is about to collapse. So if you see this in a downtrend, most likely price is going to collapse and you can enter for a sell. If you see this in the uptrend, price is most likely going to go up, creating high highs and whatnot. So that's my second favorite pattern. My third favorite pattern is actually the morning star, right? So if I see this, that means that price is going to reverse and it's going to hit back up and I'm going to enter for a buy. And if I see this evening star, price is going to reverse and hit down and I'm going to enter for a sell. And if you can combine all these candlestick patterns to like whatever I taught you about the key levels, so you spot the candlestick pattern at a key level, additional confluence, it all adds up together, and that is when you can enter for the trade. So bearish engulfing candlestick at a resistance level, enter for a sell. Over here, there's no pattern right here actually. Over here, you can see resistance level, evening star candlestick pattern, enter for sell. Or over here, support level, morning star candlestick pattern, enter for buy. That is what I mean, guys. Lot of chart patterns out there. There is your double top, there's your heads and shoulders, there's your rising wedges, inverted heads and shoulders, falling wedges, triangles, wedges, pennants, whatever. There's a lot of chart patterns out there. Focus and memorize just 3 patterns. Just focus on memorizing 3. Actually 2. For me, I only memorized 2 actually. And I didn't really memorize it. It just so happens that I've been trading for so long and it just stuck within me. I just can't get rid of it. I don't give a shit about wedges. I don't give a shit about triangles. I don't give a shit about pennants, whatever. Maybe they work, maybe they don't. I've never really like tested them out myself, right? Sure, they are there and maybe they work, but I don't really give a shit about those because if you look at the chart patterns, right? If you look at this list of chart patterns, the patterns that have the highest statistical win rate is this right here, the heads and shoulders, and the double top and double bottom. These 4 right here is the 4 chart patterns that I memorize. Double top, double bottom, heads and shoulders, inverted heads and shoulders. So if you see a double top, you should enter for a sell. If you see a double bottom, you should enter for a buy. If you see a heads and shoulders, you should enter for a sell. If you see a inverted heads and shoulders, you should enter for a buy. So let's look at this in real time. So example right here, right? You can see double top, double bottom, and heads and shoulders. These patterns are so goddamn common that you will literally see them in your everyday life. It's a very, very common pattern. Example, we saw a resistance level like somewhere right around here. And look at what price gave us. Go up, rejected it. Go up once again, rejected it. This is your double top, right? Double top and price collapse, right? So you could have easily ended up for a sell when price break through the neckline. And the neckline is this level right here. You can see this M, right? And then the middle, the M here, this low point, this is the neckline. So you can enter for a sell immediately when price break to the neckline. And you can place your stop loss above the one of the top and then take profit at the next key level. Once again, this is not a video on strategy. This is a price action crash course where I teach you guys how to analyze the charts. So I'm not going to go through entry and exit in this lesson. And then another scenario could be maybe let's look at double bottom. Double bottom, easily spot. You can see it's so easy to spot it. One here, another bottom here, and it just went back up. So you can easily enter for a buy when price break through the neckline right here. Enter for a buy. And the thing about double bottom and double tops is that it doesn't have to be perfectly like this. This two top doesn't have to be perfect like the same height. It can be double top, first top like this, and then the second top kind of deformed and it's like lower than the other one. In that case, it is okay as well. It is still counted as a double top as well, right? So don't be like too fixated on it must be the same height. No, it doesn't need to be the same height. Price can do whatever it wants at the end of the day. How about this? Inverted heads and shoulders. Left shoulder, head, right shoulder. You can see this is the left shoulder, this is the head, and this is the right shoulder. And once price break through the neckline, look at what price did. It went up. So easily could have entered for a buy right here when price break through the neckline. And then let's look for heads and shoulders. Left shoulder, head, right shoulder, breakthrough neckline, collapse. As simple as that. And once again, the left shoulder and the right shoulder doesn't need to be the same length. So it can look a little bit deformed like this and still go back down. It's still counted as a heads and shoulder, right? And essentially heads and shoulder is just a giant middle finger, right? Just a giant middle finger. That's how I memorize it, honestly. So this is essentially what we have learned so far. Market structural, basically price in an uptrend, price will be creating higher highs, higher lows, and lower highs and lower lows in the downtrend. And then we also learn break of structure, how to identify reversal and stuff. And then followed by support and resistance level, where we know that, okay, you should buy at spot level, you should sell at resistance level. And support is essentially like a floor, resistance is like a ceiling. And then we got trend line. Trend lines is basically in an uptrend, you want to plot the trend line on all the higher lows, and the downtrend, you want to plot the trend line in connecting all the lower highs. And you want to sell if price bounce off the trend line. I mean, trade in the direction of the trend line. If it's bouncing off the trend line, and if it's breaking past the trend line, you can trade the opposite direction. And then followed by Japanese candlesticks, we talk about the 5 points about Japanese candlesticks, and also wrap it up with chart patterns and basically heads and shoulders, and double top and double bottom, and inverted heads and shoulders. Those are 4 patterns that I focus on. Now, trading can get extremely lonely, and if you want to become a profitable trader faster, you need the help of other people. That is why I will recommend you to join our trading tribe for free. We are a tight-knit tribe of like-minded traders, all striving towards the same goal, which is freedom. This is where you can meet and network with other traders, access more free trading courses just like this one, and celebrate your wins and losses together. Now, my vision is to produce 1 million successful and profitable traders over the next 5 years. And I hope that you can join me on this movement, and together we can change the trading industry for the better. Like this video if you guys have learned something, and if you want to learn more about price action trading, check out this playlist right here. And as always, remember, you're just one trade away. Mwah.